Should you add Clorox CLX to your dividend portfolio? Let's talk about that. Hey guys, I'm the Newb investor. Today we'll be looking and screening CLX at purely financial standpoint through our three metrics to see whether their stock is trading at overvalued, fair, or discount prices. And from there, we should see if the stock is a buy or not. CLX is currently trading at 147.58 with high price of 237.74 on October 2020. That's 38% of the highs. Its market cap is 18.16 billion with PE ratio of 74.11. That's high because their EPS is very low at 1.98. If the company fails to execute a higher EPS over the next quarters, I bet the stock would fall. CLX is giving out an annual dividend of $4.64 per share, a yield of 3.14% of the current price. But is it safe though? Let's look at their payout ratio. If we divide the annual dividend by the current EPS, their payout ratio is 234%, which is bad for the stock, and if you're buying the stock for the dividend, it is not safe. They're paying investors 2.34 times what they're earning just in dividends. If this continues, this is going to be bad for the company. Let's go with our three metrics. First metric, we want an EPS multiple lower than 3. It is 37.43. So high because of the low EPS of 1.98. Now, if you think the company can execute a higher EPS of say 7 to 8 to cover their dividends and also not to have a skewed PE ratio, I'd say it's time to accumulate. But I would not bet on it. Next metric, we want to pay $1 or less for 1% of the money they're making. The values above are in billions, while the values below are in percentages of the respective revenues of that year from 2017 to 2021. They spend around 80% in COGS and OE and keeps 12% in average as free cash flow. If you're okay paying 2 times what they're making, I think it should trade around 24 PE. But in this table, we can see here that very small revenue they're making. Just with this data, I think I'll pass and let the revenue grow until the EPS catches up with the price. From the four highlighted values, which are the net income yield and free cash flow yield of the current year and the average of 5 years of data, we'll take 9.67, the lowest of the values, to divide our current PE of 74.11 to get the discount of 7.66. The PE is skewed, so I guess every metric is skewed. Historically, we're paying 3 times what it's worth then. So basically, the stock is not a good buy at this current situation. You have to assume some things here. If you're bullish on the stock and believe it can make an EPS of 7 to 8 or maybe 10 to kind of hold things together from dividends or to not have a skewed metrics and for them to actually have something spare to themselves to continue the business and buy back shares. If you think the company can 5x, 10x from here, go buy and accumulate now. But personally, I'd let the revenues catch up until the EPS meets a point where the financials make sense. For now, I'm staying far from this stock as it is way overvalued. If I were to buy this stock, it will be below $50. Brutal, I know, but that's 2 times what they're making. I could be wrong on this stock, but by the current numbers presented, it's not looking good. Don't buy it for the dividends. If you like to invest in these companies, I'd advise you to use a longer time frame of data, like 10 years of data or more. Also, look at the other metrics like long-term debt, current ratio, etc. As always, do your own research.